Hi, everybody. This is Thomas Wynn, CEO of Wynn Capital, with the 2022 second quarter market review. On your screen is all my contact info, and if you have questions or comments, please reach out anytime. Before we get into the rest of the summary, let's take a look at where we have been so far this year as far as a chart of the market goes. This dotted line over on the left is the beginning of the year, and we reached a market low. Looks on about the 16th or 17th of June, and we were down about 24%. All recessions and all bear markets are different. This one has been a very bumpy ride as we've had declines and then a 9% rally, another decline to new lows, almost a 13% rally, further decline to new lows, and another almost 10% rally. And as of the end of yesterday, we had another 10% rally. Today was down about 1%. So a bumpy ride all the way along. There are many investors that on these various declines got out. And depending on where they got out, they would have had a very difficult time trying to decide whether to get back in again. There are some people that have been out for a long time. And if they're very, very patient, it might pay off. But during these rallies, it's very, very difficult to not get back in and to underperform based on getting out and getting in at difficult times. It's the theme that everyone knows that I'm always going to harp on is it's very, very hard to time the market and get in now. Anybody that has made money for a living, traded for a living like I have, tried and usually fails to accomplish that task. There's lots of other ways to make money in the market on a consistent basis, but getting in and out is not one of them. So if we look at the summary of all these asset classes for the quarter, I've made a couple of highlights. It's obvious that everything's red and down and pretty significantly. Some of the returns are close to the worst quarterly returns ever. I've highlighted out this pandemic rally that took place in the second quarter of 2020 after the lows of the pandemic. That second quarter had a 22% return, a big bounce in a short period of time. These other bounces were the rally after the real estate bubble. And each of these asset classes had crazy rallies off the lows. Again, if you've decided to get out, it's really hard to decide when to get back in and pick the bottom. The worst quarter ever I've highlighted down here. Last quarter was the worst quarter ever for bonds, this minus 6% in a single quarter. So the long bonds down about 20% this year, and we'll get into that in a second. This looks at a longer term instead of just looking at 3 months, just the last quarter. We're looking at 1-year returns and then 5 and 10-year returns. These 5 and 10-year returns are annualized, which means that the U.S. stock market's been going up at 10.6% per year for the last 5 years, and the same with all the other returns. And then on the 10-year, we've had a long, very strong rally, and even though we've had this big decline so far, U.S. stocks are up 12.5% per year, and the annualized returns are, for all the other classes, right across the board. Even though we've had so far a really bad year this year, annualized returns that take in this year plus other positive years, we've got positive returns across the board for both the 5 and 10-year period. There are very, very few 10-year periods that don't have positive returns. This is the world stock market. This is just the second quarter. This little inset is a year. The last 3 months are highlighted. Then we have just the bumpy ride of the market, which in general has been lower, and all of the news that was coincident with various prices. Again, these are almost all statistics are trailing statistics. The market's always trying to look ahead. Each day, every minute of every day, new information comes out and it's priced into the market. Almost all of any premise that anyone can, even a professional, can generate has already been priced in, and it's not really possible to take advantage of news that you see and generate a forward-looking premise that will take advantage of the news of the day. It's already priced into the stocks. This is just a longer term period for the last 12 months. Same thing, a very, very bumpy ride going back to last June. And we had a rally up until the end of the year, and now we've had this big decline so far this year, and all the news that was coincident with the price. Now we're just going to zoom in on U.S. stocks, foreign and emerging markets. First up is U.S. I've highlighted the year-to-date returns, all really big negative returns. Value, small and large value, typically outperforms during recessions or down markets, and they're doing what they do in general right now. The growth stocks that have been in vogue for so long, the Apples and Amazons and Netflixes of the world, have had the biggest decline. I think last time I looked, Netflix was down about 75%. I think it's rallied a little bit off its lows. Most of the others have had pretty significant declines of all those large cap tech stocks, which were so popular for so long. In the international area, it's the same thing. Value is doing less bad. Growth has gotten hit the worst. Small cap has gotten hit the worst in the developed world. And again, if you look at the year to date, pretty significantly negative returns. If you go out further, 3 years still positive, 5 years still positive, and 10 years even more positive. Emerging markets, same story. Emerging markets go up faster than the other categories, and they go down faster than the other categories. They have more risk, and typically returns are, you have higher returns, but you have a lot more volatility, a lot more risk. These are country returns, and the average global is highlighted there, and then I've highlighted the U.S. right in the middle. As usual, there are some positive returns, or only one positive return, which was China. China, if you paid attention to the previous reports, had a really, really terrible time for a while there, but now has bounced. And on the other end of the spectrum was Peru. I don't know exactly what's going on in Peru, but most of the countries have pretty significantly negative returns on a country basis. Real estate, which I don't always show, real estate tends to be pretty stable, but it's had a big decline in the quarter and negative returns for the quarter and year to date. Again, if you go out far enough and you hold on to real estate, you get positive returns. Last quarter, I did an analysis. We have real estate stocks in our portfolios, but the concentrated real estate position that I have is a loan portfolio that's very stable and tends to return about 6 to 6.5% on a long-term basis, and very consistently with very little volatility. This is a graph of commodities. If you've been watching these summaries long enough, you know this swings back and forth. It's very volatile. So the oil type, energy type stocks are still having positive returns. Lots of other commodities had really terrible returns so far. Negative returns for the quarter, year to date, very positive. This is the second quarter, just for comparison. If we look at the second quarter, lots of negative returns. Last quarter, everything but one thing was up huge. So a very, very volatile category. I don't always use fixed income, but fixed income's been very volatile with really negative returns, really large negative returns from the short-term duration to the longest duration. And again, if you look further out, you get positive returns from bonds. And if you remember what the best and worst case scenarios, they're much more stable and less volatile than stocks. And in general, they're a diversifier. This is an unusual year, completely opposite from the pandemic when stocks declined, bonds rose dramatically. And in this period, stocks have declined, interest rates have risen, which is unusual. And so we've had both parts of our portfolios, both the stocks and our bonds, have had significant negative returns. And almost all the portfolios, from the most conservative that has mostly bonds, although we don't own mostly long-term bonds, we usually have shorter duration bonds. But even a 50-50 portfolio, the stocks were down significantly and the bonds were down significantly. So a lot of portfolios did not get the diversification and the conservative benefit from owning bonds, at least for this period. Over time, that's likely to change. And bonds right now have interest rates have fallen recently, and bonds have rallied. If we go to the next slide, it basically shows the year-to-date change in interest rates. Again, this line is the beginning of the year. Interest rates were about 2.9%. I'm sorry, interest rates were about 1.9% in January. Interest rates have risen and risen and risen until the current up to about 2.9%. So it's a rise of 1%. And if we do the math, let's show the chart of the math. On the previous slide, I showed the formula is the bond return equals the percentage change in interest rates times the duration. So if you have a 20-year duration, which is the duration of the long bond, 20 times -1, when rates rise, bonds go down. So use a negative number. The long bond, 20 times minus 1% is minus 20% return. That's almost exactly what the long bond is down here. So again, that's the chart of interest rates. This is the editorial from Dimensional Fund Advisors from one of their the head, Marlena Lee. I've seen Marlena lead a lot of webinars for advisors. She's global head of investment solutions. All the people at DFA are very, very competent and very smart, in my opinion. So there's 3 lessons here. I've highlighted some of the things. They're all, my philosophy is very similar to DFA's philosophy. We diversify, we keep costs low, we manage taxes, and we rebalance really dynamically when prices change, not on a calendar. Of course, we also hedge, which DFA doesn't do, but is unique to Wynn Capital. The chart in front of us just shows the shaded areas are recessions. Whenever you look at a long-term chart, especially going back that far, the big declines are barely noticeable. When you zoom in, on the 2007, 8, and 9 recession, if you zoom in on it, it looks terrible, and it lasted a long time. The 2000 periods to almost 2010, was sideways with a down and up and down again, with very low returns for people that didn't do anything or rebalance. And we've had this long rally. The current recession, the 2020 recession is what's showing there. We're not in a recession technically yet. We're in a bear market, but not a recession. And this was, you can tell from how small this was the shortest recession ever, the pandemic recession, which only lasted about 3 weeks. They go on, and I've highlighted the material, but some of the things are showing that the 1-year average return, the 1-year return after a bear market or 20% decline is shown on the 1-year average as these blocks. So 1-year returns are pretty robust. 3-year returns are even more robust. And as I've highlighted, the 5-year average return after a bear market is huge. It's why rebalancing and doing Roth conversions if you can, even raising your allocation if you can, if any of those things are appropriate, those are things you do during recessions when prices are low. It's not market timing, it's just buying things at a discount when they appear. This is the 3rd page, and I've highlighted pretty much most of this editorial. And I hope you'll take a look at it and read it. DFA and Wynn Capital are data-driven. We know the facts of how the market works, and we try to implement the things that have worked over time and not do the things that have hurt performance over time. That is it for now. Here again is my contact info, and if you have any questions or comments, you can reach out at any time. I hope you find the material helpful, and that's it. Thanks. Goodbye.